So if I told you that the absolute best performing artificial intelligence stock this year wasn't some sleek Silicon Valley software startup,
Okay.
but actually it was the company that built those heavy beige plastic desktop computers sitting in your high school computer lab, would you even believe me?
I mean, honestly, it sounds like a punchline to a joke. But yeah, it is the actual current reality of the market right now. We are watching this company just completely redefine its legacy. I mean, the undisputed king of the affordable, kind of clunky personal computer has quietly engineered a 221% year-to-date return.
It's just wild. 221%.
Yeah, and they didn't do it by, abandoning hardware. They're actually leaning into it harder than basically anyone else out there.
Which is exactly the transformation we are decoding today for you. We are doing a deep dive into Dell Technologies, ticker symbol DEOLL. And I think, if you're trying to wrap your head around this whole AI boom and you're only looking at the software side, which everyone does, right? Everyone just looks at the language models or the chatbots, the code generators. But if you do that, you're missing the entire foundation.
Oh, absolutely.
The real capital, I mean, we are talking hundreds of billions of dollars, is flowing directly into physical infrastructure. It's the metal, the cooling systems, the actual server racks.
Yeah, because people forget that software requires a massive physical footprint. A language model doesn't just exist magically in the ether.
Right, it has to live somewhere.
Exactly. It lives in a massive data center that requires incredibly complex physical components just to process the information, let alone dissipate all the heat it generates. And Dell is basically the company building the heavy machinery required to run those models.
And the financial footprint of that heavy machinery business is expanding, like, incredibly fast. Let's get into the mechanics of that because, a company doesn't just wake up on a Tuesday and start dominating the AI server market out of nowhere.
No, it takes an unbelievable amount of capital to pivot a ship that big.
Exactly. And when you look at the financials in our deep dive today, Dell's Infrastructure Solutions Group, which is ISG, the division building these AI-optimized servers, they are showing a trailing 12-month revenue growth of 38.57%.
Which is massive.
For a legacy hardware giant.
Yeah.
Growing the top line by nearly 40% is just a huge acceleration. But the part I really want to focus on here is how they are actually paying for all of this.
Well, they're funding it through an incredibly disciplined capital allocation strategy. I mean, Dell still has a very mature, highly reliable client solutions business.
That's the PC business.
Right, the traditional desktop and laptop sales division. That legacy business, it just generates this steady, massive stream of free cash flow. It's a cash cow.
Yeah.
And instead of just letting that cash sit around or paying it all out in dividends to shareholders, Dell is aggressively taking that money and reinvesting it straight into the high-growth, very high-cost world of AI infrastructure.
So they are essentially using their old, reliable cash cow to fund the construction of, like, a high-stakes rocket ship.
That's a great way to put it, yes.
But building a rocket ship isn't cheap. And looking at the numbers, the market is pricing this company like it has already reached orbit, basically.
Oh, the valuation is definitely stretched.
Yeah, they are trading at a price-to-book ratio of 32.08 and a price-to-sales of 2.14.
We should probably break down that price-to-book metric for a second because it's vital for understanding what the market expects from them.
Yeah, break it down.
So price-to-book basically compares a company's market valuation to the actual net value of its physical assets on the balance sheet.
Like the factories and inventory.
Exactly. The factories, the parts, the cash. So a ratio of 32 means the market values Dell at 32 times the actual value of its physical stuff. Now, if this were a high-margin software company with zero physical inventory, a high multiple like that is totally normal.
Because they just write code, they don't have to buy steel.
Right. But for a heavy hardware manufacturer, a multiple of 32 is an astronomical AI premium. I mean, the market is pricing in absolute complete perfection here.
So is that level of premium actually justified? Or is this just, a blind gamble by investors who are just hoping Dell can pivot fast enough?
I'd say it leans much closer to a calculated masterclass in corporate strategy, actually. It's not a blind gamble.
Okay, how so?
Because Dell is actively balancing this transition. They aren't just throwing everything at the wall. They are continuing their debt reduction. They're doing share repurchases, all alongside these massive AI investments.
So they are walking and chewing gum at the same time.
Exactly. And they are retrofitting a massive, fully operational global supply chain to build out this new tech. They already have the logistics network, they have the international footprint, the factory space.
All of it is already paid for.
Right. It's already there. They don't have to build it from scratch.
Which actually brings up a really fascinating market dynamic from our sources. If Dell has this incredible infrastructure already built, why are we seeing their stock price jump based on what their competitors are doing?
The halo effect.
Yeah, because recently, Dell stock jumped 9.31% in a single day, adding like $37.65 to the share price.
It was a huge move.
But the catalyst for that jump wasn't Dell's own earnings. It wasn't a new product launch from Dell. It was triggered by their competitor, Supermicro, announcing a record $60 billion in new AI server orders.
Right.
So I have to ask, if a competitor just landed $60 billion in orders, shouldn't that competitor be the one winning? Why on earth is Dell's stock jumping on someone else's success?
Well, you have to look at the physical limitations of manufacturing in the real world. Supermicro, or SMCI, is reporting this massive record-breaking order book.
Yeah.
But at the exact same time, they are reporting soft revenue.
Wait, how does a company land record orders but fail to translate that into actual revenue?
Because an order is simply a promise written on a piece of paper.
Ooh.
Yeah. Revenue is recognized only when you actually build the server rack, ship it to the client, plug it into the wall, and collect the check.
Right, you have to actually deliver the product.
Exactly. And Supermicro is facing severe physical bottlenecks right now. They simply cannot source the parts, manufacture the servers, and ship them at the speed the market is demanding.
Because everyone wants them right now.
Yesterday, even, enterprise customers who need AI compute power, they cannot afford to wait 18 months for a server delivery. That kind of delay could cost them the whole AI race. So that desperation drives those clients straight over to Dell.
So I want to use an analogy here just to see if I'm understanding their operational moat correctly.
Let's hear.
It's like imagine two fast food chains trying to operate during a national potato shortage.
Okay, a potato shortage.
Right, so Supermicro is the chain that relies on third-party delivery services and independent farms to get their potatoes.
Okay.
But Dell, on the other hand, actually owns the potato farms, and they own the trucking fleets. So because Dell has this vertically integrated supply chain and their own direct manufacturing capabilities, they can just keep serving fries while the competitor's kitchen just completely grinds to a halt.
That actually captures the dynamic perfectly. Dell controls its own factories. They don't have to rely heavily on third-party contract manufacturers like some of the peers do.
Right.
And furthermore, because of their decades-long dominance in the PC and the traditional server markets, Dell has incredibly deep, long-standing relationships with semiconductor giants like AMD and NVIDIA.
And those relationships are gold right now.
Oh, absolutely. When AI GPUs become scarce, which they are, those relationships really matter. Dell basically secures preferential allocation of those chips. They get to skip to the front of the line.
And being at the front of the line is critical when you look at the sheer scale of the infrastructure being built.
Yeah.
I mean, one of the sources mentioned a specific partnership between AMD and Anthropic.
Yes, the MI450 deployment.
Exactly. They are deploying up to 2 gigawatts of AMD Instinct MI450 GPUs. 2 gigawatts of power.
Yeah, that power requirement is just staggering to think about.
I can't even picture it.
Well, 2 gigawatts is roughly the power consumption of an entire small city. And that is entirely dedicated to AI processing. You can't just plug that kind of hardware into a standard wall outlet.
Right. You blow the breaker instantly.
It'd melt the building. The heat generated by that many GPUs requires highly advanced liquid cooling systems, very specific power architectures, and even structural floor reinforcements in the data centers because the racks are so incredibly heavy.
That's insane.
It is. And AMD is deploying these in their Helios rack scale solutions. And it just so happens that Dell is perfectly positioned to manufacture, integrate, and support that exact type of hyper-converged infrastructure end to end.
So this halo effect, where Dell benefits from Supermicro's announcements, is basically the market realizing that the total addressable market for AI servers is just so overwhelmingly massive.
Yes.
And the demand is so immediate that Dell's going to capture this massive overflow of business simply by being the most reliable manufacturer in the room.
The overflow is basically inevitable at this point. Think of it this way. If the total demand in the market is 100 units and the primary vendor can only build 20,
then those remaining 80 units of demand have to go somewhere.
Exactly, and Dell is just standing there with open factory doors ready to catch them.
Okay, let's shift gears for a minute and look at how the smart money is treating this stock. Because if you look at the technical charts, they are just going parabolic.
The momentum is intense.
Seriously.
Yeah.
The stock is currently trading around $441.80. That is up 105.62% over just 13 weeks.
Wow.
And it's up an absolutely massive 237.74% over 26 weeks. It is sitting just 5.9% off its 52-week high of $469.47.
Yeah, from a technical analysis perspective, it is a massive multi-month momentum rally. But the mechanics of that recent 9% gap up we discussed earlier, those are particularly revealing.
How so?
Because that jump occurred on slightly below average volume. Specifically, it was about 0.82 times the 3-month average trading volume.
Okay, wait. Normally, when a stock makes a massive 9% move upward in a single day, you would expect to see incredibly heavy trading volume, right? Like millions of shares changing hands as buyers just rush in.
Right, usually.
So what does it actually mean when the price rockets upward on lower than average volume?
It technically indicates a severe lack of overhead supply.
Which means what in plain English?
In plain English, it means the investors who currently own Dell stock have such strong conviction in this AI transition that they are simply refusing to sell, even at these elevated prices.
Oh, I see. They are holding tight.
Exactly. Because there are so few shares available for sale on the open market, even a moderate influx of new buyers forces the price to just gap upward significantly. The buyers basically have to aggressively raise their bids just to convince anyone to part with their shares.
So it's a seller's market for the stock.
Very much so. It establishes a very firm institutional level uptrend.
Okay, I hear you on the lack of overhead supply, but I'm going to push back hard on this idea that nobody is selling.
Okay, let's look at it.
Because looking at the insider trading filings in our deep dive, Dell insiders have executed a net sale of 4.74 million shares over the last 90 days.
That is a big number, yes.
Right. If this AI thesis is so bulletproof and the stock is poised for years of growth, why are the actual executives and directors running the company dumping nearly 5 million shares right in the middle of this rally?
Yeah, I mean, on the surface, 5 million shares being offloaded by insiders looks like a glaring red flag.
It definitely looks like a panic button to me.
Sure, but we really have to contextualize that volume against the timeline of the stock's actual performance. The stock is up over 200% year to date. When a company experiences a run of that magnitude, insider selling just becomes a standard function of portfolio management.
Just cashing out some chips.
Basically, executives receive a very large portion of their compensation in stock options. When those options vest, and the stock has literally tripled, they sell to cover the resulting tax obligations and, frankly, to diversify their personal wealth.
Okay, I understand the concept of diversification. I mean, if my company stock tripled, I wouldn't want my entire net worth tied up in one single asset either.
Exactly. It's just prudent.
But 5 million shares in a 90-day window, that is a massive offload right before an upcoming earnings report. Are we entirely sure retail investors aren't just, left holding the bag while the insiders cash out?
Well, we can look at institutional buying to answer that fear. If the smart money, we're talking the massive hedge funds, the institutional asset managers, if they believe this was a blow-off top, meaning, the final gasp of a dying rally,
Yeah.
they would be liquidating their positions alongside the insiders. We would see massive, high-volume selling driving the price down sharply. But we don't see that.
So they are buying what the insiders are selling.
Exactly. Institutional buyers are absorbing those insider sales and holding the stock near its 52-week highs. So structurally, the technical setup remains a bullish continuation pattern rather than a top.
Okay, so the technicals hold up. But if we're looking at the actual business of building these servers, there are definitely some structural vulnerabilities here.
Oh, absolutely. It's not without risk. Like, if these AI machines are so incredibly complex to build, requiring liquid cooling and literal gigawatts of power, what is that actually doing to the profit Dell gets to keep at the end of the day?
You've identified the single biggest risk in this entire thesis, actually. The margin squeeze.
Okay, tell me about the margin squeeze.
We really need to look closely at what actually goes into an AI server rack. A massive portion of the cost of that rack is the NVIDIA or AMD GPUs sitting inside it.
Which Dell has to buy.
Exactly. Dell does not manufacture those chips, they purchase them. Therefore, a huge chunk of the revenue that Dell collects from a client goes straight out the back door to pay the semiconductor companies.
So they're essentially just packaging, powering, and cooling someone else's extremely expensive technology.
That is exactly what they are doing. And Dell's current trailing 12-month gross margin is 19.07%. The real danger lies in their product mix.
What do you mean by product mix? Well, Dell's traditional enterprise hardware, like their storage solutions, typically carry much higher profit margins. If their sales mix shifts aggressively away from those legacy products and almost entirely toward these lower margin commoditized AI racks, their overall profit margins will compress heavily.
Meaning explosive revenue growth doesn't even matter if the cost of the goods sold just completely squeezes the actual take-home profit to nothing.
Exactly. We talked earlier about their diluted earnings per share climbing to $12.59.
Right.
Well, diluted EPS factors in all outstanding stock options and convertible bonds. It is a very pure, conservative measure of a company's true bottom line profitability.
Right.
If their gross margins collapse from 19% down to, say, 14% or 12% because they're selling way too many low-margin AI servers, that $12.59 EPS will drop, regardless of how much top-line revenue they bring in.
And if earnings drop, Wall Street is going to be pretty unhappy.
Wall Street will violently reprice that price-to-sales premium we discussed earlier. That's why the upcoming late August earnings report will be the absolute litmus test. The market is going to be laser-focused on the Infrastructure Solutions Group's margins to see if Dell is actually making real money on this pivot.
Wow. Okay, so beyond the margins, there is another external vulnerability we need to map out for you. It's the risk of sector contagion.
Yeah, the one-trade syndrome.
Right, so clarify that concept for the listener.
Yeah.
Because the market is essentially treating this entire AI hardware space, Supermicro, HP Enterprise, Dell, as just one single interconnected trade.
They are. The mechanics of algorithmic trading and passive ETFs create a very dangerous environment for individual stocks when they're in a hot sector like this.
How does that work exactly?
Well, millions of investors buy AI-focused exchange-traded funds, right, ETFs. Those funds group companies like Dell, Supermicro, and NVIDIA into a single basket.
So if an ETF holds both Supermicro and Dell, and let's say Supermicro gets hit with an export control review by the government, or they just massively botch an earnings call, the ETF itself takes a hit.
The ETF takes a big hit, and algorithmic trading bots react instantly to that. If negative sentiment strikes the sector because just one player stumbles, the algorithms initiate indiscriminate selling across the entire basket of stocks.
Even if the other companies did nothing wrong.
Exactly. The ETF manager is literally forced to sell shares of Dell simply to raise cash to cover withdrawals that were caused by Supermicro's failure.
That is wild.
It is. Dell could execute their strategy flawlessly. They could report expanding margins, hit every single revenue target. But if the broader AI infrastructure trade catches a cold, Dell is going to suffer the symptoms purely by association.
So we've covered the legacy cash flow funding the AI transition. We talked about the direct manufacturing logistics capturing all that competitor overflow.
Yeah.
We looked at the parabolic chart sustained by a lack of overhead supply. And obviously the very real threats of margin compression and ETF contagion.
Synthesizing all of these moving parts from the deep dive, what is the final verdict on Dell's position?
Distilling all the sources, the aggregated data yields an 8.5 out of 10 bullish score for Dell.
8.5.
Yeah. The consensus basically frames Dell as a fascinating short-term swing trade heading into their late August earnings, but one that really transitions into a highly compelling multi-year hold.
Even with it running up over 200% already.
Even with that, yes. The technical foundation remains incredibly robust. The core thesis rests on the reality that the total addressable market for AI infrastructure is measured in the hundreds of billions of dollars. And Dell possesses the rare global manufacturing scale required to actually convert that server demand into recognized revenue.
It really strips away a lot of the magic surrounding artificial intelligence, doesn't it?
It does. Beneath all the generative models and the advanced algorithms and chatbots, the entire industry is just completely tethered to physical supply chains.
Yeah.
The software is only as capable as the metal it runs on.
And you know, that physical tether introduces a really interesting geopolitical dynamic that we should probably touch on before we wrap up today.
Oh, the sovereign AI stuff.
Yeah. There are speculative rumors circulating in the sources about Dell securing multi-billion-dollar sovereign AI data center contracts in the Middle East. And at the exact same time, you have companies like OpenAI launching localized enterprise agents that require massive back-end upgrades.
The whole concept of sovereign AI really changes the entire landscape. We are essentially watching AI development fracture in real time.
We are.
It is shifting away from these centralized global clouds owned by a handful of Silicon Valley tech giants, and it's moving into localized nation-state controlled data centers.
Exactly. Every government is suddenly realizing they need their own internal AI infrastructure, completely physically isolated within their own borders, purely for national security and data sovereignty reasons.
And when a nation-state decides to build a sovereign AI network, the leverage completely shifts away from the software developers and straight toward the hardware manufacturers.
Yep. A country cannot run a national security AI protocol if they cannot actually get the physical server racks delivered, cooled, and powered within their borders.
So the companies controlling the supply chain for those physical components suddenly hold immense geopolitical power.
Huge power.
It just leaves you with a fascinating reality to consider. You know, that the next era of global technological dominance might not be determined by who writes the best code, but by who can manufacture and deliver the most server racks.
It's the new arms race, really.
It is. The bulky, beige plastic tower sitting on a desk 20 years ago hasn't just evolved. It has quietly become the most critical and potentially the most powerful piece of infrastructure on the geopolitical chessboard today.